Well, Mr. Constancio,
Yes.
you've unsurprisingly identified an intensification of the financial crisis as one of the biggest risks to financial stability. Do you assign any probability to the likelihood of a worsening of the crisis?
No, not really. What the methods and models that we have project what may happen, but do not attribute a probability of such more adverse scenarios occurring. No.
What, in your view, has to happen to prevent the crisis from worsening?
Well, the implementation of the things that have been discussed and decided, in particular by the summit of heads of state and government, regarding the improvement and strengthening of governance rules and fiscal discipline in the euro area, and also in making fully operational and efficient the backstop facilities that have been decided some time ago, meaning the FSF and the anticipation of the ESM, which has more flexibility and can be more efficient than the current FSF. So these two things are absolutely essential. The decisions have been taken, and now implementation has to be really convincing in order for the markets to see that the decisions are followed through and the instruments are put in place in order to contain the crisis.
Well, governments have disappointed you before, so what makes you confident that they'll come through this time?
Well, you know, the fact that they thought before that they had solved it, and they have verified by experience that that was not the case. So the developments of the crisis itself, I think, are a big incentive and motivation for them to deliver this time.
What if they don't? Is the ECB prepared to do more if it needs to? You'll be aware that markets want the ECB to, for example, buy more government bonds.
Well, we don't pre-commit with anything, so we have programs that are ongoing. As nothing on earth is eternal or infinite, of course, and we don't pre-commit about what we will do. You will see every week what we will do in order to face our responsibilities in addressing the crisis.
Does that mean that you would be open to further rate cuts if needed?
Well, again, I don't comment on what may be our future policy, but I think that by now everyone in the markets have concluded that, as we have done several times, we really do what we consider necessary, face the situation as it evolves.
Okay. Can we just talk about the measures that you have announced for this week? We have an unprecedented 3-year loan. Do you expect banks to take up that offer in numbers? What's your expectation for demand?
Well, I cannot put a figure to it, but I would think that it would be significant, of course, because it's an important instrument for banks. They face very high refinancing needs early next year. Refinancing needs related to the repayment of medium-term debt, so they can get liquidity from us, precisely medium-term, to face at least those refinancing needs. So that means that in principle, yes, I think they will come significantly, but I really cannot predict.
Would you expect banks to use some of that money to buy government bonds? In other words, do you think that this measure that you've introduced could have some downward pressure on bond yields?
Well, that was not the intention. As I have mentioned, the banks face next year the refinancing needs very high. As you have seen in the markets, they have not issued medium-term bonds and other medium-term instruments, which means that the markets have not been very favorable to that. So they face really big financing requirements, and getting liquidity from us is for them a way of facing those requirements more than anything else. So I think that was also the main motivation for our measures.
But do you think they could reinvest some of that or put some of that money into the
Wow.
bond market, government bond market?
They could. I mean, according to, of course, are there portfolio management decisions. But again, what we saw was that banks were under pressure because markets were not providing the amounts of liquidity that they require, even to maintain the level of activity that they have. So that's why we took the decisions we took to provide the liquidity and to really be able to say that banks cannot use the excuse of not having funding or liquidity to embark into more significant deleveraging or a credit crunch.
Okay. You see the risk of a credit crunch as being real at the moment?
Well, of course, in the situation where the economic outlook deteriorates, the credit risk increases, the reaction of the banks is to tighten their criteria of credit analysis, and so that risk is there, of course. Also, they were mentioning that the funding difficulties were also another justification for them to be more restrictive in granting credits. And what we did was, in fact, to eliminate that reason. Funding, liquidity as such, cannot be used as an excuse for not continuing to finance the economy.
Okay. Now, in your financial stability review, you don't look at the possibility of an exit from the Eurozone by a country or a breakout. Could you explain to us why you haven't considered that to be a risk?
Well, I think that it is really unthinkable that that could happen for all sorts of reasons. So we don't see the need, and I would say even the possibility of such analysis. So the consequences are so huge, or could be so huge and unpredictable, that it is virtually impossible to plan for it. So it's unthinkable in all dimensions of the world.
Okay, and just finally, do you think that there is an increased risk of deflation next year?
Well, deflation is too strong a word. If there is a double dip, a recession, of course, deflationary probabilities will increase, but I don't see really a possibility of deflation.
Thank you very much.